Good evening, everyone. I welcome you all to Carnelian Quarterly Catch Up. Thank you for joining in. This time, the topic for our call is bringing clarity to chaos, and followed by a session of question and answers. Over to you, Vikas.
Good afternoon, everyone. Thank you very much for joining us on this call like every quarter. We really value your time and interest in joining us on this call regularly. And we couldn't have chosen a better day for a topic like this. We are seeing all across chaos. Markets are again have turned very volatile today globally as well as in India. So I'm sure all of us are worried and thinking what's happening. So we'll try to do our bit of sharing what we are making out of the current situation. How should we see from a shorter term and medium term and long term through this in this at this current point in time. Also, I think sessions like this become a lot more useful when we have two-way sort of interaction. So I request all of you to, please make it interactive. Feel free to ask your questions and share your views. All of you are, equally accomplished, businessmen, entrepreneurs, and people in your own field. So we love inputs which we get from our clients always. So yeah. So with this, let me start our bit. So, friends, I think we're seeing markets have been in a very, very sort of chaotic situation in the recent times, and there are many concerns are coming about. Of course, all started with last year with the Ukraine war. Before that, things were looking picture perfect. All set for a good trajectory. Everybody was bullish, and Ukraine war started, and I think threw lots of things into spanner. Interest rates went up. Inflation went out of the window, which forced Federal Reserve to increase interest rates sharpest in the history of the last 40, 50 years. And still, war continues. It doesn't seem to end, and probably at times you keep hearing noise of escalating, as we heard yesterday with Biden visiting and Putin responding with his own threat of nuclear. So I think still we haven't seen any major respite. It calms down and surfaces again, and we know that things like this don't settle in a short time. We know that how long Gulf War had continued, and many more wars had continued in the past. So I think that continues to remain worry and a concern for the investors. Of course, our recent local issue in form of Hindenburg and Adani saga has added more to the chaos, and which kind of at one point in time stabilized, and I believe that it continues, and we'll chat more on that. But I think so. Lots of chaos has been there in the market, and all of these have created volatility, and which has been unprecedented, and of course not easy to handle. When you are investing, especially from a short-term perspective, but also when this kind of volatility happens, it tends to shake people's belief. Also in a medium to long term as well. I've seen many people then turn risk averse in a situation like this. So we'll try to bring some sort of clarity in this. How should one see? What are the major concerns? What are the things one should look at? So if you see currently, there are two big concerns. A lot of concerns which boils down to these two basic things that we are expected to see earnings slow down in the growth, which means earnings growth both at a global level and local level. Global level more prominently or more pronouncedly. Of course, that also has an impact at a local level as well. So we are seeing economic growth a bit of a slowdown, and we'll talk more about that. And second, I think everybody seems to be finding India very expensive compared to historical level and related to emerging market. And we'll touch upon both these two topics, that how should one see. But these two issues have kind of definitely created market uncertainty along with other other issues, and led to almost kind of no return in last 12 months or 15 months. And even if you look at 2-year period, India has not delivered some great return. And if you see any asset price, I mean, a combination of definitely this, why, what has led to this? What has it resulted into this? India has delivered 9% return, in last two years, CAGR, last 12 months, almost flat or no return. So what has led to this kind of situation? I think two very fundamental belief we have is that I think A, we saw a sharp rise in the interest rate, and B, expected earnings slow down, right? Now let us step back and how does any asset gets valued? And if we analyze that and just look at each component of that, and then start sort of evaluating, we will get a lot of answers. So any asset, whether it is equity, whether it is fixed asset or fixed income or real estate, anything, generally you will have three components to value that asset. ROE, meaning returns on that asset, or cash flow or returns coming from that asset. Secondly, growth expected in that earning, if earning is growing, and lastly, interest rates, right? And this is easy to understand in the context of, let us say, in the context of a leasehold property. I mean, many of you might be owning a leasehold property and all. So if I have, let's say, rental income coming on a property, and I know that, let's say, 100 rupees rental income coming, and there is a interest rate is 10%, you can capitalize and make it 1,000 rupees the property of the value of the property. I mean, that's a very simplistic way, right? The moment if I say that 100 rupees rental is growing at 10%, the valuation of the property will change, right? Same way, if I say the interest rate is instead of 10%, 8%, valuation of that property will again change. So, and if I, so essentially, a combination of these three always plays, a role in the value. And if you have to understand where the asset prices are going, you have to have a view on each of these components, which will eventually sort of determine your return of investments, right? And if you see last 12 months, what has happened on each of these components, right? ROE, I think India has been steady, I think 14-15% kind of range for quite some time. Earnings growth, which was expected to be, before Ukraine war started, I think most people expected 18-20% kind of earning growth trajectory, which ended up being around 11-12% this year estimated. Still, I think last quarter is left, but if I take whatever is expected numbers coming about, we will be in and around 12% kind of earning growth. And we had sharpest rise in the interest rate, right? So we had 250 basis point kind of increase in the interest rate, and that has essentially sort of and so last year almost we had no return, so zero return, despite 12% earning growth. It means what? The valuation came down by 12%, right? It's only in last 12 months. And if I look at the same thing over a 24 months period, we had almost 9% earning growth, sorry, 9% nifty returns and 27% earning growth. So on a CAGR basis, we are we have got de-rated by the difference between earning growth as well as the index return, right, on a 2-year basis. So we have seen a sharp de-rating taking place, and that largely that de-rating has taken place because of a very sharp increase in the interest rate, which is about 250 basis point. And that the moment you take a view on that, you will figure out how it can pan out in the future, right? So this is a clearly this is a very, very big reason for how the returns from the asset class can be explained over last 12 months and 24 months. Specifically last 12 months, it has got a lot more pronounced because a huge amount of uncertainties have come, which has led to interest rate increase and which has led to a bit of a doubt around the earnings growth. So let us examine each of these components. How does it look from here, right? ROE, interest rates and growth, because these components are going to be very, very important. We can take short-term view, medium-term view, and long-term view on each of them, and figure out how it is sort of going to be. Now, standalone ROE basis, I think India has always kind of done well as compared to emerging markets. India continues to remain very good return profile in and around 15% range. Many and there will be periods of up and down, but I think generally speaking, Indian ROE profile has been decent profile, and I think that is expected to remain in this pretty much range. I don't see any major change happening on that. To inflation, interest rates, I think that is a very critical, important question to be answered. And our view on that we have outlined in the past as well, as that we are pretty, and we have seen peak of the inflation. In my opinion, if you see pre-COVID, pre-Ukraine war, pre-COVID level, we had three last year three major price hike, which was food price, energy price, and commodity price. All led to, I mean, sometimes because of the COVID related issue, which got kind of exaggerated by the war. So all these three things came together and pushed inflation in a trajectory which was unmanageable, unhandleable by I think any business, anybody, right, across the board, across the globe, right. Though I think India ended up managing it so well that we did not felt the impact as much as I think many other economists felt. But having said that, we did also feel, because everything is interconnected in this world. And so we think that as we, as all these three prices, whether it is food grain prices, commodity prices, and energy prices, all are come down to pre UK Ukraine war levels, and thereby you have a high base, and the prices have come down. So you will start seeing, and you have already started begun to see the print of the inflation, sort of beginning to taper off. Of course, it can still run for a quarter or so, and the central banks being obviously data dependent and cannot preempt, because they have to manage not only inflation but inflationary expectations. So they have to sort of act with the lag, and once the data gets sort of confirmed, and that is how we believe that they already kind of tapered off their expectation of the potential future rise. But we think that most of the rise, we are at the tail end of the interest rate cycle. Maybe last rise is kind of around maybe 25 basis point, max 50 basis point, but that's there, and beyond that we don't see. So we believe that inflation has peaked out, interest rates have peaked out pretty much, if not in a reality but in actual expectation, because markets are already expecting whatever interest future 25-50 basis point kind of interest rates is in offing. And thereby also US dollar index has peaked out, and that we have already seen kind of coming down in the last 4 or 5 months. So that itself is so I think that they're very clear that we are at the tail end, and you don't have much significant larger scope. Most of the uncertainty, damage around inflation, interest rate is behind us. Now only one can argue whether it is 3 more months or 6 more months. Nobody would know that, but we will feel it's more like closer to 3 months than the 6 months. So next 3 months, I think most of the interest rate, inflation related concerns will be behind, and we know that global growth, I mean growth everywhere, has been slowing down, and the very purpose of interest rate, sharp rise in the interest rate, is to slow down the growth, right? How else you will control inflation, right? Inflation comes for two reasons. One is sharp demand, and second also supply side shortage, right? It was more supply side shock, but also we had a sharp rise in the demand, especially in economics like US, where a lot of money was distributed in the hands of people, which took the labor supply out of the market, and at the same time gave money for consumption. So you had a double impact on especially in US and European countries, where people got credit of $4,000, $5,000 a month. Now when you are a labor working in the port, you are getting a credit of $4,000 a month, which is pretty much closer to your salary. Why would you go and work? And that took out the labor from the market. Thereby, there was nobody to unload the ships, and thereby the entire supply side kind of got stretched. So all those things played out, right? And because of that, we saw a huge amount of impact on the inflation. I think all those things are reversing. Freebies have been taken out. Government has pulled out that. Government is pushing on $1 trillion. This I'm talking about US $1 trillion investment program. All those things are being built, and they will have sort of impact, in my opinion, over a period of time. So I think that is behind. Coming to the growth, of course, especially Indian GDP growth, I think this year we will be slowing down. It is there, not only our this thing. I think last year we FY23 will grow at 7%, and if we grow next year between 6 to 6.5%, I think it'll be a good outcome. And corporate earnings growth is expected to be in the range of 12 to 15% next year. Again, it depends a lot, and there could be somewhat risk to downside still, but we will only know in the time. But right now, the expectation of the earning this year is again a bit of a moderate, not on the high end side, but a moderate. And you can also say that this is partly reflecting the current, and we all know that nobody can predict how things will pan out. This always also reflects the current market, current sentiment on the recent past always gets reflected in the anybody's projection and predictions, right? So one has to take these numbers with that kind of pinch of salt and on the growth side. Now, why India is so resilient, and we need to kind of, or what is the resilience? Why we think that India has huge amount of resilience, and if we understand that, because ultimately all these things we have seen many such volatile periods have come passed by, and some of them might it's always good to revisit that, and we all hear that from a medium to the long term perspective. But India's resilience is very very sort of strong, and many things might be repetitive, might be appearing like cliched and everybody knows about it, but actually they are the fact, they are the realities, right? And fact that we have a large population, 1.43 billion dollar 1.43 billion people, and huge working age, median age with 28. All these people are working, so producing and consuming, and you don't have any other profile of a country which is having this. And if you ask me, this is what provides the resilience. And this is not only in this period, even historically, whenever India has kind of suffered through this part has always provided the resilience, because we are a producing country, we are a consuming country, and our consumption continues to remain strong. And this will be also one of the biggest trend as we move forward over the next 5-10 years. Indian population's aspirations have been sort of ignited in the recent past, and that is kind of leading to a significant demographic dividend, and that will continuously. Today, if you see, when we talk to companies in the semi-urban area, most companies are giving a very robust outlook that the demand which comes from there, the growth which is coming from the semi-urban and rural side is far higher than any of the metros or big cities. So that is again telling you that India is sort of getting spread, and the demand is coming from every corner of the country, and that's the reality of it. Second big part is that and this second one is also going to be answer to big chaos also, that India is a very we have a very healthy balance sheet. From the 2008 financial crisis to now, every nation in the world has increased their leverage. India is only one of the probably handful of one or two country which has reduced, which debt to GDP has gone down. We remain one of the most under-levered nation on the earth, and that is true. Government is not over-levered, corporate sector is not over-levered, household is not over-levered, right? And if you see history again, credit is a very big growth for provides very good growth leverage for the growth. So we still are under-levered, and we have a huge runway for us to grow. We can take more debt to grow, to meet our aspiration. And also this provides from the downside question that we are not in a, if suppose there is a chaos happens around the globe, we are not levered to feel as much pain as of any global crisis into India, right? So that also is a question. So on the downside also it's a good thing, and it provides us runway for the growth. And this is a very very essential part of sort of India today. And corporate India today, why they are able to grow, expand, because the balance sheets are very very solid. I have never seen this kind of solid balance sheet of the corporate India ever in the past. So we are very solidly sort of ready for, from a capital standpoint of view, as a country to grow. And related point is investment cycle has is peaking. We are seeing both public and private capex is sort of ramping up. If you look at the order books of the capital goods companies, it is very very robust. They are accruing. The delivery cycles have elongated. On the public investment, infrastructure investment is also very robust. We are seeing roads, railways, metro, port, everywhere massive investment is happening. So we are seeing this investment cycle continues to remain very robust, and especially in light of next year election, even in the medium term to short to medium term also will continue to remain robust. And our manufacturing side, we have spoken on many forums many times in the past. We continue to remain very positive. We think manufacturing is one of the decadal opportunity in the country, where because of government's focus to reduce imports, substitute imports, and focus on exports, and make our GDP balanced in services, agriculture, and manufacture today, which is very very poorly positioned, as far as the manufacturing is concerned. Once that happens, I think India will be very resilient. So manufacturing side provides huge amount of growth and comfort, from that standpoint of view, and huge amount of investment is happening on that. India remains one of the most favorite destination. I'm sure most of you have heard this, in last couple of days, Deepak Bagl's statement also very sells India very well. But fact is that we have been, receiving FDI flows every year after year, historic FDI flows, and the data he shares is that 50% of, total, last 75 years, FDI investments has come in last, sort of 90 months, and that's a staggering number, right? But that also shows that India is one of the hottest market, and most companies, MNCs and international players are looking India with a very serious sort of attention, both from a demand perspective as a market and as well as from investment perspective. Many companies are setting up India as a manufacturing hub for their countries, moving away from China and also catering to the local demand in India. So that's a very positive sign, and I think that also likely to remain so. I don't think that's changing anytime in soon. Lastly, our strong banking system. I think we have a very very robust banking system. Last 7-8 years of pain which we went pre-COVID level post IL&FS crisis. I think most banks have been sort of provided for, well capitalized, no asset quality problem, and ready to grow. And if we are seeing reasonably good credit growth coming in, by most banks in the recent quarters, which is a 10-year high of 17%, which I think tells you that economy is moving in the right direction. While a lot of noise is there around, but still that continues to remain very very robust. And so credit is growing, and we remain one of the under leveraged. So you can imagine that this twin engine can sort of fire earning growth for India. So yeah, so I think our earning growth, we think again ROE and interest rate we spoke, and growth side I said that this year probably could be a little muted, but next year again should pick up. Again, now it's very hard to predict any precise number, but the range is something easy to. I think we should be able to get to 15 to 18% trajectory, and who knows? By the way, it could very well change even through the course of this year. One should always take these predictions with pinch of salt, because ultimately a lot of factors contribute to sort of changing the growth profile. So if let's say 3-6 months down the line interest rates peak out, and they globally there's a talk about cut in the interest rate, market will act in advance, and things will start changing, right? So I think these things change, but I think broadly speaking, a 15 to 16% kind of growth is quite possible in a foreseeable future. And India, if you compare to other emerging markets, India remains one of the most promising market compared to any other emerging market. Whether you look at earnings growth, whether you look at ROE profile, you look at on any parameter, right? And the balanced growth, by the way, size of the market. I think India is a very sizable market. We have a very wide, diversified sectors available. It's the most efficient market, easy to get in, easy to get out. First time FIs have been able to sell so much equity without having an impact. This, by the way, goes long way in getting their flows back. I mean, I'll talk about when are we expecting the flows back later, but I think this is a huge positive for India, that FIs have been able to sell when they wanted to sell, without much impact cost. Historically, 10 years ago, this was unthinkable, right? So I think India is coming of age compared to any other market from a stability point of view, liquidity point of view, sustainability point of view, and that's very very sort of essential for any markets to scale. And this, by the way, over a period of time leads to reduction in the risk premium and higher valuation. So because every market has a risk premium assigned, and as markets become stable, more balanced, more diversified, more liquid, easy to operate in, the risk premium keeps on going down, and thereby valuation keeps on going up. And that's again, India is in that, getting into that trajectory slowly every year better. So again, these three factors which I talked about, right? ROE, growth, and interest rates. So our clear view is that ROE, I think India is sorted. In a long term, medium term, short term, we will be 15 to 16%. I don't think any major improvement or deterioration in that, in that profile. Growth this year could be 12 to 14%. Next year, I think onwards we will get into 16 to 18% kind of trajectory. I don't see major challenge. Interest rates, we think that short term, probably will be firm in and around these levels. I don't see a major significant uptick. Medium term, next 12 to 36 months, we think it's coming down. Probably the conversation around interest rates coming down will start, later part of this year itself, because I think most of the, I mean, at least I can see that in India, it's working out, because I think India does not have a major challenge around the inflation given its tolerance level of 4 to 5%. And and longer term, I see interest rates getting stabilized at in and around 6%. So trajectory of the interest rate from here only looks better. So look, again, I go back to that. India got derated last year because of the rise in the interest rates. As it goes down, we will see again re-rating happening, but it's a sort of a process which will pan out over a period of time, not happening overnight. But I'm saying that one has to keep in mind while looking at the markets, right? I mean, if you were to take again short term, it's very easy, but if you were to take long term, how does one, if I were to, like take the base of 2023 as we speak, March 23 earning, and assume different earnings, growth profile, whether it is 14% earning or 18% earning. I mean, you can kind of see, and if it is in between 16% earning, and value India at 18 times P and 20 times P. Right now, India is trading at around 20 times P. I don't see it will get derated, in a big way as India grows. But assuming even whatever number you can take, so India can be anywhere between 40,000 to 50,000 Nifty, in next 7 years, and which is a very sharp return. So you can see on a good scenario, maybe 3x return at the index level. Of course, stock specific can be very different, but that itself kind of promise one has. And by the way, those who seeing this with a bit of a skepticism, let me say that in 2002, Nifty was 800 points. Today it is 16,000, whatever. So almost 20 times in last 20 years, right? So 20 times in 20 years is about 17.5% CAGR. So we have seen this kind of, and this similar kind of growth has been, by the way, in the earnings. So we have seen a significant growth in the earnings and the markets in over longer period of time. So longer period of time, these things tend to play out. Shorter term, they always kind of are hard to sort of believe. But long term, if you see, and if you see last 20 years, every possible uncertainty, whether it was UPA 1, UPA 2, global financial crisis, 3G scam, coal scam, Brexit, Middle Eastern conflict, pandemic, GST, demonetization, COVID, you can think of any possible thing, man-made or natural, all kind of things have happened. Despite that, it has kind of done that. So long term, things do play out. And if you see in this last 20 years, what again has played out, why it has done well is again our demography, strong sort of economy, and of course we have had our own volatile periods, but it has kind of delivered over a period of time, right? So we think that India should look good in that period. Now, I think other very good question. Most people think that ask us very often that how do we see FI flows coming back to India? Why FIs are not sort of buying if India is so attractive? It's a very right question, that why are we only so bullish, and why FIs are not able to sort of see that kind of. So India receives flows. If you see, India is part of emerging markets, so the very few India dedicated funds globally, because India is still seen as a small market, and it is changing. It's not that but when the global capital allocators think, still they change with a lot of lag. So perspective around India is beginning to change, but still I think it will take few years for them to have India dedicated fund. Like earlier, Japan was considered part of Asia. Then it became Asia ex Japan, and Japan became a separate market to be invested in. Japanese fund came about. I mean, Japan focused funds came about, right? So same way, I think this happens with the every country as it goes through the profile. Growth profile. So I think right now still India is part of the emerging market basket, and it is at least 3 to 5 years before India will see large India dedicated funds being rolled out. And the very typical approach towards emerging markets is when Fed, this is a rule book of last 30, 40, 50 years. Whenever Fed starts raising interest rates, most of the capital investors globally, they pull out money from emerging market. Rightfully, if you see why why they do that, because very simply speaking, if Fed raises interest rate, emerging markets typically are current account deficit, so they import inflation. As they import inflation, their interest rate goes up, their economy slows down, their equity market returns go down. This is a typical thing. So you know that, if you are a global investor in an emerging market country, when Fed is raising interest rate, your equity value will go down and currency will depreciate. So you will have double whammy. And as a result of that, they start pulling out money, not only when actually Fed starts acting, but much before that, when Fed starts even talking about it. And that is what has been happening in last, uh, you know, uh, last 18 months or so, or after Fed started talking about raising interest rates or giving noise about that. Same thing had happened in 2014 also, when India became part of Fragile Five, and when the taper tantrums were happening, from the last GFC expansion of QE quantitative expansion, easy. So, and the same thing comes back when the interest rate inflation has peaked out and they start looking to come down, right? So we think that the same thing will play out again here as the interest rates, like we spoke, has peaked out and they're coming down. So you will see next sort of 6 to 8 months that we're already seeing the selling flow has ebbed. You don't have massive selling coming now, but you don't have inflow. As that starts sort of easing off, interest rates peaking out or coming down, you will start seeing FI flows coming towards emerging market and in India in particular. In the recent past, India saw also a bit of a FI outflow because a lot of emerging market funds earlier who were underweight China, and China corrected significantly, we all know, they had to rebalance and go back money from China. So if you earlier, let's say, had 100 rupees in emerging markets, you had to allocate, let's say, 20 rupees to India. India's, now if they were allocating 30 rupees to India, that they were taking away from China, because China that time was not promising. But if China starts looking promising, that 30 will become 20 back, to India. So that 10 will go from India and go to China. So, but overall emerging market pie is not increasing. But once the overall emerging market pie is, let's say, goes from 100 to 150 or 200, then you will see that incremental flow coming towards India as well. So that I think is likely to happen, and we think that you will see money flow coming through. And imagine that last 18 months, despite so much selling, our domestic flows saved us, and that continues to remain robust. So if that continues to remain robust and additional FI money comes, I think that will also be a very big re-rating event, because liquidity always in a shorter term re-rates market. So I think that also will be a good welcome thing. But I think that is more likely to happen towards second half of this year than the first half of this year. A lot depends on how the interest rate environment starts playing out. But I think it's more later part of this year looks like a good possibility. So this is how we are seeing. So what one should do in times like this, from investor standpoint of view, we all know that uncertain times are best time to invest, provided one is confident from long-term perspective, provided one is assured that this is not a systemic crisis, is not going down the hills where there is no breaking down of the system happening. So if we all believe that, and which we believe that India is in a very significant growth phase. It has been, historically also delivered very well, especially now India has repaired so much on many counts. India is reformed in last, 5-7 years on many counts. So I think we are, in fact, rather better placed. So so we think that this is the uncertain times over next 3 to 6 months, best time to allocate capital. We do not see any systemic risk to India's story. Even if some global chaos happens, we don't see a systemic risk. There could be tremors. There's no doubt it will all, we are interlinked world. There could be tremors, but I don't see any risk to systemic risk to India. Even I don't see any systemic risk to ongoing saga of Adani, which many people have talked about. I think the leverage is, we have spoken to some of the companies very well who lend them. It is secured against the cash flow generating assets. Whatever is there, the holding company level are against some security. So we do not see any major systemic risk because of this issue. A lot of bank stocks have been sold because expecting that, but I don't think any of the major crises will happen because of that. So but at the same time, I think in a shorter term, very hard to see what factor will play out, where risk always comes from unexpected and unexpected. Last year, if I was talking to you at this point in time, I don't think anybody knew that Ukraine will come and which will change the course of the over next 12 months completely, which it has done. Not only 12 months, it has actually changed many things, probably permanently. So that kind of thing has happened, right? So we are in a complex world, interlinked world, very hard to predict at too many macros, too many things. But one thing, at least we believe that India is, we can do assess quality business, quality management, who will win in the long run, who will create value in the long run, who knows how to handle risk of the business amid this volatility. And those are the kind of winners, at least we are focusing our energies on. And we believe that any uncertain time continues to remain best opportunity to deploy capital towards those kind of companies, managements who will eventually deliver from long-term perspective. And that's what our focus is, and that's what I would recommend to our investors and all of you to do it. Too much focus on ongoing volatility is probably, I would see this as an opportunity rather than a threat. Some of our portfolio updates, how are we doing from a Carnelian standpoint of view, and then I'll probably open for the questions. So I think in our multi-cap fund, which we've been running since last 3.5 years, since May of 2019. Of course, last 2-3 months have been a bit of negative return. So while we are down about 1%, markets are down 3.5%, but since inception we are up about 16% annually post all our expenses versus 12% of index, and which is what I think we as long only fund managers are supposed to sort of outperform the index, and and which is what I think has been done here. Our shift strategy, most of you would know that we were the ones which we picked up. This is in August. We started investing from October 2020, 6 months after the pandemic. We saw two very big shifts happening in the country, namely manufacturing and technology. Of course, today many people are talking about China plus one. We talked about in October 2020, picking up the trend very early on that this is a decadal opportunity, and hence we launched a separate product focusing only on manufacturing and technology. Technology, I mean IT services. So and that strategy has done very well for us. If you see, it has delivered CAGR almost 38% return post all our expenses versus index of 21%. So that has done pretty well, and we think that that this is here to stay for long period of time. And same strategy we had launched called Carnelian Structural Shift Fund in an AI format with again focus on manufacturing and technology, but bit of a tweak where we are also investing into up to 30% into pre-IPO companies, some of the unlisted companies, but 70-75% listed companies. And this again has done well. With this we launched last year in April, and we continue to and in last year, as you know, that environment was very tough. BSE gave negative 1% return, but this fund was up about 13%. So this has come out very well on an absolute basis, 10% up, on an annualized basis about 13% up. So this done us very well, and we remain very, very positive about this fund as well. We are still raising capital in that. We should close this anytime in next 2 months. And the last one, again this year, last year exactly around a year ago, we launched a strategy called Yield and Growth Strategy, where we focused on, here we built a portfolio of company which is going to benefit from the inflationary pressure. Last year, please understand, before Ukraine war, I think inflation was around the Ukraine war, inflation was surfacing, and we saw that assets which benefit from the inflation and also generate dividend yield. So high yield and moderate growth, that was the theme of the strategy, and beneficiary from inflation. So this strategy also last 1 year has delivered about 15.7% return post all our expenses versus index of minus 1%. And here we had kept the benchmark in terms of 10 years GSEC plus 200 basis points, because we wanted to position this strategy as an absolute return strategy, and that's how we said. So even this benchmark we have outperformed, but purely market perspective, we have also outperformed that fund as well. So these are the 4 sort of major strategies we done. Of course, we done bespoke portfolio, which are very, very different returns for different clients. So but a bit of a color on our portfolio qualitative part, because we talked about earnings growth. So if you see, our earning growth in compounder fund is 21% versus Nifty's expected growth of 16%. Our portfolio P is 21 times versus in Nifty of 18 times. Our PEG ratio is 1 times. Our portfolio price to book is 4.7 times versus Nifty of 2.9 times. Our ROE is 21% versus Nifty of 15%. So we built a reasonably good portfolio, and we think that if these companies deliver based on our expectation, we should generate this kind of returns. And same thing in the shift strategy. Earning growth is 24%. P is 22 times. ROE is 17 times versus Nifty. Yield and growth, it is by design expected to be slow growth and low valuation. So both growth, P, everything is lower than the Nifty. And in times like, we think that this still continues to do well. And same thing is structural shift fund, which I spoke about, the AIF. where we are raising capital. This is again earning growth is 22%, portfolio P is 23 times, ROE is 20 times. So these are some of the glances on the qualitative part of our all strategies. What has worked for us in the recent past, I'll just quickly touch upon. I think what worked very well for us last 12 months. I think is we took an aggressive call last year that banking and credit will do well. We could see acceleration in the credit side, and that has worked very well. We were significantly overweight on the credit side. We have seen significant outperformance in the capital goods companies, which we could early identify the theme and benefit from there. Auto component helped us because we were overweight on auto component side. IT, first part of the year we gave a huge pain to us. Then we saw recovery. But good part, we felt was that none of the companies reported bad numbers. Market hypothesis was that earnings will majorly slow down because of US slowdown. Nothing of that sort has happened. Order book accretion continues to remain well, and as the attrition rates go down, and currency is also helping. So IT sector should be one of the decent performing sector. So that has also kind of helped us. What has not worked well for us is, I think, in BFSI non-credit, we had few non-credit stocks which did not work well for us. One in insurance, one is in the broking space. Both, I think, has given us reasonably good amount of negative return or an alpha. Pharma API CRAMS, we had few players in our portfolio which is kind of also not done well, as the entire industry last year did not do well, and we also kind of took a knock on that now in our portfolio. And then there were some stocks which did not perform as per expectation. So we had some stock specific underperformance as well. So it's net. I think you will have some winners, some losers, but I think we came out reasonably all right. We think that and we have of course learned from our last year's mistake. We are improvising on that, but that's a continuous learning process. I don't think hopefully we'll not repeat our mistakes. We'll make new mistakes. But net, I think we were able to pick some trends pretty early on. That has helped us a lot. Connect dots early, and whether it is and part of our magic basket. As many of you, that we constantly look for companies where there is a magic event happening, where we can get both earnings growth as well as the valuation re-rating. That tend to do very well. This year, I think we had significant addition in our main fund in terms of Aditya Birla Capital, which has played very well for us and also contributed significant alpha. Like that, we had some few more magic stocks added to our portfolio, which has kind of done well last year. I'll just quickly touch upon that, and maybe I'll get to Q&A, because I think we probably keep it more Q&A focused. So I think banking, we continue to believe that looks good. It is a good scenario. Credit growth is coming. As long as the interest rates are holding on, I think they will continue to have a significant margin expansion also, or good margin rather, I would say. And when the interest rates come down, probably you will see some compression on the margin. But that's next year's story. I think this year, through the year, it should continue to remain fine. NP, like I was saying, asset quality is good. Corporate credit growth is coming, both corporate and retail. And I think we are still significantly under-penetrated on the credit side. So the sector looks well poised from a growth perspective, both on the banks as well as NBFC. Automobiles, I think we have seen cycle start. Most companies are doing well. After 4 or 5 years, we are seeing demand remaining robust. Company, of course, there are still some companies facing semiconductor shortage, but by and large that's behind. So we are beginning to see good growth coming, and I think auto sector will continue to do well. Manufacturing, we've spoken a lot. We think that this is going to be a decadal opportunity. Huge amount of PLI. Basically government focus on Atmanirbhar Bharat is boosting huge amount of investment across the board in the manufacturing. And it will not be exaggeration to say that I don't know any company which is not expanding based on its own capacity. Small, big, large, based on their balance sheet, everybody is preparing for growth. So I think first time I'm seeing those animal spirits are back from an investment perspective. Entrepreneurs are willing to take risk. A, because the balance sheets are solid. B, I think opportunity is looking very promising. So, I think, and it's a combination of all, right? One is government's focus, China plus one is spurring demand side, where customers are demanding that can you deliver, Our cost competitiveness with China is already improved. Our labor cost is $200. China's labor cost is $800 and growing. Our power cost is cheaper than China. So I think a lot of counts we are becoming better. Of course, some many places we are inefficient, like logistics cost and the ecosystem which India is building. So net, I think we are in a good spot as far as the manufacturing is concerned. We will see many companies in fullness of time will become 5x, 10x, will become global scale companies. We have seen that happening in the past. We've seen when pharma sector did well, Sun Pharma became from 1,000 crore market cap company to 3 lakh market crore company, and many more. In different sectors. So it's, many companies we have seen when the trend plays out. In IT, we saw in 2002 to 2008 cycle, we saw Bharat Forge became 12x, Thermex became 10x, L&T became 15x. So we've seen that how companies scale up when there's a tailwind and a good growth trajectory. So we see similar kind of trend playing out in manufacturing over next 5 to 7 years. Many companies today who are 1,000, 2,000 crore can become 10, 15, 20,000 crore large company. And this has played in the past, and we think that will play out in the future. Of course, you have to identify those winners and stay put, invested into those companies. And we think that India has potential to have many such companies coming from the manufacturing sector. IT, again, India continues to remain market leader with 90% plus market share. The growth of the sector is, inevitable. It will, because today, there's no company which cannot afford to which can afford not to spend money on IT, right? Of course, like one insight I can give you when we're talking to a few senior people in today, given when the US is in a difficult situation, every CEO of any large company will be reluctant to spend a lot of money on IT. They will do only what is bare minimum needed, right? The development IT expenditure always gets pushed because we don't know environment. Even the CEO of those companies also won't know environment, how it's going to pan out, right? Everybody is dealing with uncertainties. So once that interest rate cycle uncertainty is behind, at least our channel checks suggest, people tell us that the IT spend, once that trajectory changes, will come back, because then one would be very comfortable around the global growth environment in US. So while in Indian IT companies have won significant orders in a difficult environment, when the environment gets better, that is likely to accelerate. That's why we believe that IT is a 3 to 5 year opportunity, and IT spend is going to grow at 13-14%. NASSCOM has guided that this IT services exports will go to $350 billion from $170-180 billion, or $200 billion. So it will go there, and India will sort of benefit a lot. And in IT sector also has huge impact on the employment generation back home. So this sector we think will continue to do well, and it's a defensive sector with cash flow generation. So we remain quite positive on that. With that, I will just pause here, and too much of monologue. I will love to hear your views, suggestions, questions. Please feel free to ask any question, suggest anything you think.
Thank you, Vikas. I would request the participants who wish to ask questions to use the raise hand option.
Hello.
Yeah, please go.
Yeah, my name is Amit Naik. I have a question slightly different from the equity market. The thing is that we have a solid liquid equity market, but we do not have a liquid corporate debt market and GSEC market. Recently, RBI has allowed the retail participant to invest directly in the retail, in the GSEC market and the treasury bills. So what do you think about what should be done to deepen the corporate debt market, GSECs and treasury bill market? What are your thoughts on that? How could we deepen the market? How could we liquid it more liquid like equity market?
I think this has been talked about for 15 years. I think every SEBI chairman who comes, I think always talks about it, puts an effort. But I think it's a kind of a issue between RBI and SEBI who takes control. Currently, the debt side or trade side is completely controlled by RBI, and because it falls into in two regulators area, still I think we have not made significant progress. But we have begun right now. There are lots of corporate bonds which are at least being, they're raising capital from the market. So beginning has been made, but it is nowhere close to where it should be, especially for markets like India. I mean, this is a subject one can talk about a lot, but there's nothing one can do about it till the time regulators, and it is also the top priority. But I think it will happen, the day it has to happen when the stars are aligned. It will require a lot of regulatory framework and support and coordination to make it happen. Everybody talks it about, but it's a elephant in the room. Somebody has to bell the cat and get it going. So so I think it will take time. I mean, it's progressing slowly, but it's still far from where it should be.
The thing is that RBI has already allowed retail participant to open the retail direct yield account with RBI. At the awareness of this has I myself has opened account with the RDB with the RBI, but the awareness is like I suppose is lacking. So retail investors can invest in GSEC and treasury bills without any intermediation like with the RBI. So is it because of that there is a lack of awareness creating this problem?
No, so it's again, it's both. So I think lack of awareness also is going to increase. So it's not that you're right that awareness also has to be there. So still in India, financial literacy is very low. In equity, at least you see the price, but in bond valuation, of how to price and value the bond, it's also very complex. It's not easy for anybody to understand. So it is going to take time. It's definitely not easy for retail investors to understand. So easily.
Okay, thank you, sir. Thank you.
Yes, Mr. Kumar.
Hi, Vikas. I'm following you since few years. First time I heard you when you were a panel speaker sponsored by a Singaporean hedge fund few years back. Anyways, you're looking again more mature in the new look. Okay, coming back to the question, this manufacturing and technology shift towards manufacturing and technology, this is being discussed since many decades. My father used to tell me that by the time Rajiv Gandhi became the prime minister, his focus started on manufacturing and technology. What is so different this time that we are so emphasizing so deeply on manufacturing and technology? Number one. Number two, we are talking a lot about technology, new India, young India, digital India. All digital India stocks have been fallen badly. Last 1 year, we have seen Paytm, Card Trade, Policy Bazaar. We have seen many stories. So how you will, I mean, what view you are carrying over here, Vikas?
Sure. So I think manufacturing, like I think we have done many seminars on this, and I would strongly encourage. We have a 1 hour presentation explaining on our website. If you listen to that, I mean, I will of course summarize right now, but if you listen to that 1 hour presentation, you will really get every nuance of it. Why we have done detailed work around that. So this time around, I think post pandemic, post COVID, I think game has changed on 4 counts. One is, of course, government's focus on making India self-reliant, right? Government realized that our vulnerabilities on the China is very high, and whatever reason we know that Doklam happened and all. So China does not need to fight war with you on the border. They can switch off supply of APIs. Healthcare system is down. So clearly government is not only PLI but many others, like non-tariff barriers where they are putting non-tariff restrictions for import, like toys export from China to India has come down by 60%. And government made a small change that anybody who sells toy into India has to have BIS mark. Now, whom to give BIS mark, not to give BIS mark is government's prerogative. So that way they are putting a lot of barriers so that local players get opportunity to sort of build ecosystem and fact. So government is working very smartly and focusedly to reduce our imports. And so it has never happened with this kind of intensity, focus, and positive approach towards making it happen has never happened in the past before, as has happened post-COVID. Secondly, China plus one again is a very change on the demand environment. Earlier, companies were very comfortable buying from China. It was going on. Everybody was, appreciating China and very used to it. Now we have realized that everybody wants to diversify away from China. It is no more only about cost. It is about resilience. So, how resilient is your supply chain, even if it is a bit expensive? That is very, very important. And everybody is, and India is now competitive. It's not that India is expensive, but India is also competitive. Like I was explaining, our cost competitiveness vis-a-vis China has already changed. So earlier we were not competitive. China was more competitive than us. So even if you wanted to push, your economics won't allow you. So today that economics is falling into your favor. China labor cost is $800. We have $200. Now that is a very big advantage for you to manufacture. Our power costs are lower than China's, which is again a very big advantage. China historically gave huge amount of subsidies to their exporters, which is not happening now. China earlier was polluting; they were not focusing at all on the pollution, which of course reduces your cost of production. But now with the carbon emission norms, China is forced to sort of shut down those industries or focus on pollution. So historical advantage of China on the cost competitive side has gone down. So if you see combination of all these things, is changing the environment in a big way. And I think this time around, this ship has sailed. There will be slowdown, there will be hiccups, but I don't think there's a U-turn. So that's the reason we believe that manufacturing is here to stay, and will create huge amount of value. And Indian entrepreneurs are very, very smart. They are getting a level playing field. They're getting support from the government against unfair competition, which was coming in the past, which they did not get in the past any support. Now they're getting. So we think that this time around it's very different. It's a very, very promising opportunity. And I can tell you, 2 years ago, also there were very few takers of when we launched our fund. There were very few believers on that. And today there are more believers than than in 2020. And I think 2 years down there will be more believers, because it is always when you see results you believe, right? So that's what we think. As far as the technology is concerned, I think we invest into IT services with the cash flow and all. I think the new tech, we saw a huge amount of euphoria, especially during the COVID period, where I think companies got valued unreasonably high, and so it is nothing to do with the technology profile or digital India profile. India has transformed itself into based on the digital stack, which is unparalleled in the world, and that continues to remain. That has nothing to do with the loss of the market cap which has happened. That is to completely do with the euphoria, and the investments got done into euphoria. This happens in every market cycle. Fortunately, last 3 years through the COVID, we never got tempted to invest a single rupee in any of the new tech. We believe that it was day one, that it was a euphoria. So we stayed away. In fact, last year we wrote a note saying that this is a fad. The title of the note was "Fad, FOMO, Fade." That's a fad. People are acting or investing out of FOMO, and it will fade away. And in hindsight, we turned out to be right, that those FOMO-led investments have only sort of lost money for investors. So investing is never about being part of a trend. Investing is never about chasing major crowd, or be part of. You have to be convinced about your own investment thesis, that why it will play out, what valuation I'm paying. It is wrong to believe that you can buy at any price and make money. It has never happened. It can never happen that you can buy stock at any price, and your investment outcome or return outcome will be all right. It never happens. I mean, we all know, when you buy a real estate, I mean, buying at any price, what can happen. So any asset class, forget about equity, any asset class, you should know what price you are paying. And if you overpay, your outcome is going to be either loss of money or suboptimal return. And so that has to be very, very carefully navigated, in my opinion. And some of the valuations which got triggered for those new tech was kind of, in my opinion, out of window. And why new tech? Even last year, many old age companies got valued way out of 60 times, 70 times P on a chemical company. We have seen what has happened. So whenever there is a sort of fad or FOMO happens, you tend to see these kind of bubbles getting built, and they get punctured over a period of time. Idea is to stay away from them. Idea is to protect yourself from them, and stay to the core. So that's what we believe.
If anyone wishes to ask any question, request them to put them in the chat box, or please use raise the hand option.
Yeah. Yes, Vikas.
Yeah, you can hear me because
Yes, I
sorry,
can.
I'm impressed with the detailed answer, so couldn't resist me to ask one more question.
Sure.
We have seen the quality sector, quality stocks doesn't remain same for a longer period of time. For example, we have seen 2000 time where reality infrastructure became a very huge hit, and we have seen how all reality sectors boom. Then lately we see how tech stocks boomed very high. So how do you resist this temptation? I mean, how do you resist to get trap of it? Like today, reality sector, a few people are bullish, few people not bullish. So how do you see that the rotation of the cycle, and how do you make a fine line whether it is a time to enter or time to exit?
So of course, you have your own valuation methodologies. See, one thing you will be able to find something when very cheap and something is very expensive. So that will be very clear to anybody that, and I don't think, what we are saying today, anybody who invested into Paytm knew that it is overvalued, right? But, they believed in the narrative being created. And if you believe in the narrative being created, you're buying not out of a valuation, but by narrative. And so very clearly, are you buying story or data? And as long as you're buying a sort of data driven validated approach, I think you should be okay. So we do a lot of work. I mean, and sometimes it's very hard to tempt, but it's very tempting, but you have to stay disciplined, very clearly. Like I said, we were wrong when stocks were going up, Zomato was going up or Paytm was going up, and some investors questioned us, why are you not investing in the new tech? You will miss out. And we said we don't understand how to value them, and we don't understand how these companies will have cash flow ever in next 5 years. So if I don't have visibility of the cash flow next 5 years, how do I value it? And I'm okay not to invest into that. So it's again sticking to your need, what you understand. Don't and there's a saying in the market that you can never make money out of borrowed conviction. So, I cannot make money out of borrowed conviction. I have to have my own conviction. And your conviction will depend on how you look at companies. So we don't understand that space. It's not that we are blind to it. We don't, watch them. We don't observe them, but we didn't understand. Hence, we didn't invest. Yes, Vikash.
Thank you, sir. Thank you for the good, nice, crisp presentation. And I had just one query. What is your outlook on the PSU banks and infra theme? Because infra theme is clearly linked with the capex of the private and public sector in railways, ports, everywhere. So how do you see that sector performing from here on?
So I think PSU banks, I think, like I said, that, all cleaning has been done. They are benefiting from the recovery of the return of assets. They're benefiting from the credit growth. Valuations are in their favor. So I think it will continue to do well. Of course, the long-term challenge of finding the stable management team still continues to remain. Government is trying to change that, but still there is at least surely a trade, from a next 6 to 12 months perspective. Uh, Infra stocks, yes, I think, spending is going up. There are very few infra companies, which are clean, which can be betted upon, invested upon. I mean, we own L&T in our portfolio. We think that, investment cycle is bigger than anything which benefits the investment cycle in a manner where corporate governance is high. You can benefit from that. We will do well. But in EPC, I think generally, governance and all, you have to be very careful about. And hence, we are always sort of very careful in terms of investing in what we are sort of careful in EPC. That has to be very, very clearly looked upon.
Thank you. Thank you, sir.
I think there's a question in the chat window. What's your view on NBFC sector? As of now, they have almost cleaned their books. I see a lot of mid and small finance banks and microfinance companies are trading at one-time price to book, even with the ROA of 2 plus and ROE of 15% plus. So I think our view, again, there is no one specific view, broad brush view, but I think generally speaking in NBFC, there are two things important. One is the liability side. So NBFC, which have a good liability side, uh, will do well, because they are, well placed, and they can get the safer assets. So if I'm a AAA and NBFC, I can borrow cheap and I can go after the safer assets. But if I'm, let's say, not well placed, then I'll borrow expensive, and then I have to kind of go for that kind of profile. So we have always stuck to safer models in that, because it's a leverage business. So you can't really chase, in a leverage business, risky asset. And that's what we always advise. So not to go after smaller NBFC, and especially when many of them gets, I don't think many companies are trading at below 1 time book. Most of the NBFCs are trading at 1, 2, 3 times book. Hence, we have to be very careful. Microfinance business, we don't like, to be very frank, because that's a very politically sensitive business. And if you look at history of 15 years, I think no microfinance company has created any meaningful value or worth, for the simple reason, because every now and then you have some shock from a political point of view to the collection. So you can give money, but collection is always hard. So we have, we don't believe in that, microfinance business model. We don't believe in the small finance business model. In a banking business, you have to stay with a robust franchise, with a strong liability side and strong risk management and strong technology, which is very hard to build by a smaller company, because if you build high technology, it's a cost. Then your profitability will be compromised. If you chase risky assets, your risk will be compromised. So we are very careful in terms of choosing any of those models. Mohit is asking, what's your view on Adani stocks? So I think we don't invest in. We have so far not taken any exposure in last 3.5 years on Adani stocks. Again, for the simple reason, like I was giving previous answer, that we don't understand their valuation. We don't understand many of the business growth profile. I think only stock which probably you would look at is Adani Ports, which is, I think, very, very strategic asset around the entire coastal line of India. They have a very large, monopolistic situation. So that business should do well. But when a group is positioned like this, you always have, you can't ignore, you can't see one company in isolation. Everything is together, right? So, we have kind of stayed away last 3.5 years. So far, we haven't, sort of evaluated, and I don't think we will get anytime soon closer. Who knows in the future, if we think something changes, we might do it. But so far, we don't have any view in terms of invest or not invest. Currently, we are staying away.
We have a question from Jay Kishan. Please go ahead.
Yeah. Hi. I have a question on general insurance companies. So, if you like, I mean, look at the data, like last 3, 4 years, or we can say 5 years, their motor insurance premium is not growing at healthy rate. Largely could be due to separation of OD and TP, and go-digit, intense competition from go-digit also, and some new player. So over there, premium is not growing. So player like ICICI Lombard, which is listed, so we get good information. So what they are saying now, we will more focus on health premium. Similar trend is also, if you look at like just monthly data, so they're also saying that we'll go to the health premium. So my question is, the OD gross claim ratio has deteriorated over last 2, 3 years because of competition, and now again everyone is saying we'll go to the health premium. So over there, so overall, do we see that next 2, 3 years this general insurance valuation will not grow or degrade further, or overall contribution will remain elevated?
Got it. So I think in both insurance, life and general insurance, according to us, will be going through a period of little bit pain and consolidation for 2 reasons. One is, I think recently IRD is working on issuing unified license where life insurance companies can sell general and motor and health. So at least on a health side, we see the first impact coming through, where competition coming, and chasing more. While overall industry will grow, but I think within players there will be competition for the market share and can have impact on the pricing and stuff like that. So and same thing in life insurance, we've seen what happened in the budget, and that has sort of taken away that extra advantage life insurance companies had in terms of going after the ULIP based assets. and that I think will also kind of slow down. So you will see this sector will go through a bit of a another, in my opinion, 1 or 2 years of transformation, or some bit of a challenge. So and that will always have an impact on the valuation in a shorter term. So we used to own ICICI Lombard, which we sold. We used to own Max Life, which we sold. Currently, we don't own any of the insurance companies, and I think we are watching, but I don't think we are going to be in any time in a hurry to buy those businesses.
Yeah, okay. Thank you.
Yeah. I think Tushar has a question that there is a general slowdown in consumption, especially rural. Are your data point collaborating on this? Any other thoughts? So I think, this time around, it's a very, uh, of course, the inflation has impacted. We saw a very steep inflation, right? So inflation has impacted, by and large, not only rural demand, even urban demand. If you look at consumer discretionary, air conditioners and refrigerators, and I mean those players have seen significant slowdown in the volume. And not only rural, semi-urban area, urban area. I mean, and whereas at the same time, some retail companies have delivered very robust growth. So we are seeing bit of a very conflicting data point coming from different quarters, and at times one is perplexed that how should one make out that out of this. So but in general, inflation always impacts with a lag, and we are seeing in last 3-6 months that getting impacted. uh, our own view is that it should sort of settle down somewhere through this year. I mean, we currently don't have any kind of direct consumer durable play in our portfolio, only for the same reason that but as kind of inflation comes down, commodity prices comes down, the ability to pass on that benefit to customers and thereby go after that should happen. So it's a kind of mixed thing, and currently we are watching consumption space, and that's the reason we don't have much exposure to index and entire basket. Karan's question is, Karan Maheshwari, what is your view on effect of rising interest rate on environment on the capex cycle of manufacturing companies? Thanks, Karan. So I think the good question. I mean, see, interest rates have gone up by 250 basis point, no doubt on that. But see, interest rate, according to me, is also a global play, a global factor, right? So if interest rates are going up for India, it is going up globally, right, for everyone. So it has a component. It has a very large component in the cost competitiveness of your product. So it is gone for everyone, and hence, it should be not be impacting much. Secondly, this time around, most of our manufacturing companies are also well capitalized and leading the capex, starting with good, decent equity contribution. And of course, so earlier if the equity and debt was 30-70, today probably it will be 60-40 or 50-50 kind of thing. So I think to that extent, your the nature of the right now, at least early part is changed. So we don't think there's going to be significant impact, especially most of us and believe that these interest rates rise is global, and so it changed for everybody, and it will eventually come down again. And when you're making 3 to 5 years perspective, we have not seen. In fact, what had an impact on manufacturing cycle was actually commodity prices. If you see last year when the commodity prices went up sharply, many companies held on their capex, because if you were putting a 200 crore capex, suddenly your capex went to 300 crore, and that would definitely have your IRR or everything changing, economics changing, right? Because if you are putting 200 crore capex and suddenly everything goes to 300 crore, how will you recover your capital? But if the interest rate goes from, let's say, earlier you were borrowing at 7, it goes to 9, I think it's not as significant impact. And the second point is that it is global. So, like, to give you some sense, US mortgage rates earlier, if they were 0, India we had like 9%. Today, US mortgage rate is 6%. We are still at 9%. So the gap of I have never seen this kind of sort of narrowing down cost of capital in India being cheaper than global, adjusted for the currency hedge. So today, not many companies borrow internationally for the simple reason borrowing cost in India is cheaper than internationally. So I think we are reasonably okay on that. But having said that, lower interest, better it is for the cycle. And as it settles down, I think it will have positive impact. But I don't see the major dampener from a capex point of view.
Vikas, we have a follow-up question from Vikash. I just unmuted. Yeah, Vikas, please go ahead.
Yeah. So what is your view on this thing? Port and airports, sir? Because many many other new airports are coming up as per the government vision budget document also. So like, is there any smart player other than GMR airports? Because Adani Enterprise has a airport division, but they are, I mean, dealing with their own situations. In that case, GMR could be a very big, opening up a very big business slice also, because they are owning quite a few airports, good airports in their kitty.
Yes, I think airport is a good business, promising business, future business. I mean, I haven't studied because I think GMI is a conglomerate and they have a power play, they have a lot of other stuff. But in general, I think airport is a very good business.
Okay, thank you so much.
I think there's a follow-up question from Karan. Can we expect any disruption by new age fintech companies? I think, of course, one thing I believe that this has been talked about a lot, fintech being, a threat to the large players and all. And my own view has been, let's say if I have to buy, insurance or a life insurance, most important thing according to me is more than the ease and everything else is the fact, reliability or trust that will I be able to recover my claim. That is the most determining factor, right? Now, none of the fintechs can bring that. I mean, same thing. Why only in the case of insurance? Even in case of banking, people said that fintech will disrupt banking, and according to me, it can never happen because banks bring huge credibility, liability franchise, which fintechs will, not get probably in next 100 years. Because fintechs can bring technology, and if I have to get between money and technology, I think technology is easy to build. Most large companies like of ICICI Bank, if you see, they have a huge spend on technology today. So what is it that they cannot build? Every now large company, decent company is having massive amount of spend on technology. So technology started as a differentiator, is becoming a hygiene factor according to me. And most good companies should be able to adapt, build or buy technology. And many of these fintechs will probably get sold to them. But can they be a threat to large players? I doubt. I mean, that's my own view. Of course, some players will come, they will create a new business model. There are online, only health insurance companies which are being built unprofitably. I don't know any which is being built profitably so far. How long they can sustain, especially when the winter is there for the funding. So I don't know that, frankly speaking. So I'm more believe. I mean, I don't sort of. We have not invested into any of those, and we will be very careful, in putting money behind that, those kind of stuff.
Amit, you may go ahead.
Yeah, my name is Amit Naik. See, I have a question on rates and InvITs. In the recent budget, Nirmala Sitharaman has put taxation on the rates and InvITs. So do you think that this is a dampener to the overall development of the rates and InvITs market? Because currently we have only 3 rates and I think 5 or 6 InvITs. And it is also dampener on the infrastructure, because banks are not lending money to infrastructure companies because of the NPAs and all those issues. Thank you.
So InvITs and REITs are good asset classes. They are coming about. Of course, recent changes have been bit of a dampener, but I think people will find answer through smart structuring and all. Of course, REIT and InvIT has not become a big asset class for India because of these reasons only. Because we have had many uncertainty time and again around the taxation and all those things, and that's the reason this asset class could become very big, but it has not become. And we have seen foreigners coming and buying, building private REITs and InvITs and assets like this, who are kind of making nice yield. Ideally, it should be done, but that's the that's the reality. So we got to stay with it.
Thank you, sir. Thank you.
Yeah, Viraj, are we done? Vikas, you have one more last question?
No, done. It is done.
Great. Thank you very much, everyone, for joining us this afternoon and spending your valuable time with us. Thank you very much for joining us. If you have any more questions, please feel free to reach out to us. We will be more than happy to answer any of the queries. If you are interested in any of our products to invest with us, please free to reach out. We'll be more than happy to again attend to that. Thank you very much once again.